Good morning, professor. So we're making like a case analysis about the Baker's Adhesives Company. So the Baker Adhesive is a manufacturer situated at network established by Duff Baker's father. So Baker Adhesives is overwhelmed by different firms that gave most of the adhesives in global markets and the United States. So, sorry. So looking at this case study, Nova's original bill was in the Brazilian currency that was 109,081, and they were expecting they would get an overall revenue of 12%. So converting the money at the standard rate of exchange is multiplying the 109,081 times 0.4636, who give us $50,570. So if the estimations were made on the June 2016 exchange rate basis, which was on both currencies, the benefit turns out to be lower than anticipated because of the descending development of exchange rate. So 109,081 times 0.4368 would be around 47,647. So in this way, the loss of sale because of the money movement is $5,570 minus $47,647. So that's gonna be around 2,923. So the original profit margin was 6,068, which has now reduced to 3,145. So it was expecting to be 5,570. Expecting that number, the net revenue has reduced to 6.21% from 12%. So, as Van recommended, the risk could have been best overseen by supporting it as either cash or forward business markets. So, different choices can lead to reducing the exchange rate risk. Those are the calculations. And then, about all these, Baker Adhesive should use good mediators to communicate with Nava. So we look at two situations that can be very beneficial for Baker Adhesives. So the first one is that if Nova pays the sum in dollars than Brazil currency, it would be a great idea. Also, as compensation, Nova pays higher add-up to Baker Adhesive for facing the challenge of managing in international markets. So the company could have some different choices to deal with the exchange rate with its arrangement with Nova. For example, supporting in the currency markets would permit Baker to make any money trades at the realized current spot rate. So to do this, Baker would need to change over future expected incomes into current incomes. So this would be finished on the currency market by getting today in foreign cash against a regular future inflow, or making a deposit today in an outside record account to have the option to meet a coming surge. So the sum of B obtained or saved would rely on interest rates in the foreign money, since Baker would not wish to move pretty much that required. And the other option is to hedge in the forward market, because Baker would need to hit an arrangement with the bank where the bank would give the Baker an insured exchange rate for the future trade of monetary form. So these agreements indicate date, adapted trade, and rate. Any bank charge would incorporate with the rate. By making sure about a forward rate for the date of foreign currency denominated cash flow, Baker could dispense with any risk because of cash volatility. So for Baker, this implied the foreseen future inflow of genuine from the deal to Nova could change over at a rate that would be known today. Thank you very much.
Hi, Professor. This week I'm doing question number 2, which is, assuming Baker agrees to the new Nova sale, determine the present value of the expected future cash inflow, assuming the first one is there's no hedge. And I did my calculation. I got 67,785.26. And there's non-hedging transaction will expose the company to currency exchange risks. For second, hedge using forward contract. I got the number for the present value is 67,673.2. The last one, the money market, I got the answer for 66, 8 and 21.75. And in the next slide, I put an Excel in it. That's it. Thank you very much. Thank you for listening.
Hello everyone, so today I'll be talking about question number 3 and question number 4 from the case study Baker Adhesives. Okay, so the question number 3 asked if the money and forward markets were in parity. And before answering that question, I want to give a little preview of what happens if the company decides to hedge in forward and in money markets. So if the company decides to hedge in forward market, the company is required to enter into a forward contract, and then they will specify the amount, forward rate, and maturity date in the future. And if the money decides to hedge in money market, it means the company would have to follow its initial order and therefore continue with exchanging the currency at spot rate. So when an income from a foreign production is reported, there usually is a exposure called as translation exposure, and there could be either gains or losses due to this conversion and volatility in EPS. So there are different types of parities. If money and forward markets were in parity, this action would be called as absolute purchasing power parity. Absolute purchasing power parity, or otherwise known as like triple PPPP, is best defined as when a product is sold at the same price despite the currency. So this occasion hardly ever occurs, and it only happens when there are no transaction costs, no tariff, or tax expenses. And we decided to eliminate this option because this theory cannot be applied to our calculations. And there's also relative purchasing power parity. It determines the causes of differences in exchange rates, which basically means that the that it tells us why the exchange rates are different. And we believe one of the biggest reasons is relative inflation among the countries. And if Baker Adhesives decides to hedge in money or forward markets, there will be an interest rate parity known as IRP, and IRP usually holds, but in certain occasions it doesn't, and in that situation arbitrage opportunity occurs. So we decided to calculate US real rate and Brazilian real rate. To calculate the real rate, we used the formula nominal interest rate subtract inflation rate. So I found two inflation rates from the Google. I searched for US inflation rate in 2006, and then the one that I found was 3.23 for US, and for Brazil I found 4.18. And when I put those numbers into the formula, I found US real rate of 5.29, and for Brazil it was 22.82. To answer the fourth question, we believe the forward market hedge is more profitable than the other two options. When forward market hedge is implemented, there are less exposure risks. As for money market hedging, there will be exposure risks such as short-term exposure or long-term exposure or the translation exposure. So we also have to account the exchange rate risks. When using the non-hedging transaction, the number was higher, but then we also account the exchange rate risks, and when we do that, the PV of non-hedging transaction will reduce, and this leaves us with one safe option, which is forward market hedging. And one big disadvantage is that forward contracts include credit risks, so that means they could default. And it usually happens if there will be any failure of delivery on time. And we believe that Baker Adhesives should accept the new order and carry on with the forward future contract. And when they do that, they will reduce the net loss from currency exchange. Thank you.